In a rapidly evolving global landscape, the tension between economic strategies and political narratives continues to shape international relations. Recent developments highlight this dynamic, particularly concerning the influence of China and its implications on global trade routes, as well as the interplay between state control and market sentiment within China's own economic framework. On January 23, 2025, Chinese officials announced a significant initiative aimed at invigorating the nation's sluggish stock market by mandating that pension funds and mutual funds increase their investments in domestic shares. This directive is set to require mutual funds to boost their holdings of onshore stocks by at least 10% annually over the next 3 years and compel commercial insurance funds to allocate 30% of their new premium revenue to equity markets. Wu Qing, chairman of the China Securities Regulatory Commission, emphasized the potential impact of this policy, stating, "This means that at least several hundred billion yuan of long-term funds will be added to A-shares every year. This move comes at a critical time just ahead of the Lunar New Year, a period traditionally associated with increased consumer spending in China. The government hopes that revitalizing share prices will encourage households to spend more, thereby stimulating economic growth." However, China's stock markets have struggled in recent years, with a significant portion of household wealth, less than 5%, invested in equities. This is markedly lower than in the United States, where nearly 30% of household wealth is tied to stocks. Thus, the need for the Chinese government to foster a more robust equity market is urgent, particularly as consumer confidence has waned amid falling housing prices and stagnant share prices. Despite these efforts, the success of such governmental interventions remains uncertain. Historical precedents suggest that attempts to manipulate market sentiment through regulatory measures can often backfire. Stephen Innes of SPI Asset Management likens such efforts to trying to ignite a fire with damp wood, indicating that success may be fleeting. Moreover, the government's recent announcement to enhance foreign investment in Chinese markets while aimed at improving market conditions has faced skepticism, particularly given the prior sell-offs by foreign investors and the volatility that has characterized Chinese equities. Simultaneously, across the Pacific, U.S. political discourse has taken aim at China's role in global trade through the lens of the Panama Canal. President Donald Trump recently reignited debate over Chinese influence in the canal, which the U.S. relinquished to Panama in 1999. Trump's assertion that China is operating the Panama Canal has sparked significant controversy, with both China and Panama rejecting claims of Chinese control. Panamanian President José Raúl Mulino refuted Trump's comments, asserting that the canal is managed by Panama and is free from foreign interference. The canal, a vital artery for global trade, handles approximately 15,000 ships annually. While a Hong Kong-based company, Hutchison Ports, operates ports at either end, experts reaffirmed that these operations do not equate to control over the canal itself. In fact, the neutrality of the Panama Canal is enshrined in its constitution, a framework designed to prevent any single nation from exerting undue influence. Despite the geopolitical rhetoric surrounding the canal, analysts suggest that Trump's comments may be less about the canal's operational control and more about a broader strategy to curb China's increasing influence in Latin America. The U.S. is the predominant user of the canal, accounting for 3/4 of its traffic. Yet as China forges diplomatic ties with various Latin American nations, concerns about its growing presence are palpable. As the Chinese government continues its efforts to stimulate domestic markets and the U.S. grapples with perceptions of foreign influence over critical infrastructure, the interplay between economic policy and political narratives remains complex. Future developments in both regions will undoubtedly shape the global economic landscape, influencing investment strategies, consumer behavior, and international relations for years to come. The effectiveness of China's market interventions and the U.S.'s response to perceived threats will be crucial areas to watch as both nations navigate these challenging waters. As President Donald Trump embarks on his second term, a flurry of policy changes is creating waves across the United States and beyond. In a move that could significantly impact trade relations, Trump has threatened to impose tariffs on products from Canada, Mexico, and China. starting February 1, 2025. This announcement has raised concerns among economists, business leaders, and foreign governments about the potential disruption to global supply chains and the American economy. In his inaugural speech, Trump asserted that he would enact a 25% tariff on goods from Canada and Mexico, claiming these nations are facilitating the influx of illegal drugs and migrants into the U.S. He further indicated a 10% tariff on Chinese products, alleging that China plays a role in the trafficking of fentanyl, a powerful opioid that has ravaged communities across America. Trump's threat comes just 10 days before the proposed tariffs would take effect, adding urgency to negotiations that could reshape U.S. trade dynamics. The economic implications of such tariffs are profound. Canada, Mexico, and China collectively account for over a third of U.S. trade, supporting millions of American jobs. In 2023, these three countries purchased more than $1 trillion in U.S. exports while providing nearly $1.5 trillion in goods and services to the U.S. economy. Economists warn that a 25% tariff could lead to a contraction of the U.S. economy by hundreds of billions of dollars and could potentially dismantle the existing trade agreements that have facilitated this robust exchange. Historically, tariffs have been employed as tools to rectify unfair trading practices. However, Trump's approach appears to intertwine trade policy with immigration and drug enforcement objectives. It's a unique and unusual strategy, remarks Douglas A. Irwin, an economic historian at Dartmouth College. Trump's administration has signaled that the tariffs are not just punitive but could also be leveraged in negotiations, especially regarding drug trafficking with Mexico and Canada. In response to Trump's threats, officials in Canada and Mexico have taken proactive measures to mitigate the potential tariffs' impacts. The Mexican government has ramped up its efforts to deter migration and has increased seizures of illegal opioids. Similarly, Canada has pledged additional resources for border surveillance, including new helicopters and drones. Recent data indicates that irregular crossings into Canada have decreased significantly, suggesting that these efforts may be yielding results. China's response has been more measured, with a spokesperson indicating a willingness to engage in dialogue to manage differences and expand cooperation. Historically, China has made commitments to curb fentanyl exports, which complicates the dynamics surrounding the proposed tariffs. As the countdown to February 1 continues, business leaders and economists are bracing for potential fallout. The supply chain challenges we've faced in recent years will appear mild compared to what's on the horizon, warns Jonathan Kohlhauer, Managing Director of Global Supply Chain Management at UST. The interwoven nature of North American supply chains means that tariffs could increase consumer prices and disrupt manufacturing operations across multiple industries. Trump's tariff threats echo past incidents from his first term, wherein he contemplated similar actions but ultimately backed down. Whether this time will yield different results remains uncertain. As the global landscape evolves, the impact of Trump's policies will be closely monitored, with implications extending far beyond trade as they intertwine with immigration and drug enforcement strategies. In conclusion, as President Trump charts a course for his administration's second term, the coming weeks will be critical in determining whether these tariffs will be implemented and how they could reshape the fabric of U.S. trade relations. The outcomes will likely reverberate not only through the American economy but also across international borders, setting the stage for a complex interplay of negotiation and policy in the months ahead. In a bold move to revitalize its struggling stock markets, the Chinese government has directed state pension and mutual funds to significantly increase their investments in domestic equities. This initiative aims to counteract the lackluster performance of the markets, which has been a persistent issue, especially as the country approaches its biggest annual celebration, the Lunar New Year, on January 29. Officials announced that starting this year, mutual funds must raise their holdings of onshore stocks known as A-shares by at least 10% annually over the next 3 years. Additionally, commercial insurance funds are required to allocate 30% of their new premium revenue to the stock market. Wu Qing, chairman of the China Securities Regulatory Commission, indicated that this policy could inject several hundred billion yuan of long-term funds into the A-share market each year, bolstering its recovery. The timing of this announcement is particularly strategic as it coincides with a period when consumer spending typically surges in anticipation of the Lunar New Year. Historically, families use this time to purchase gifts, travel, and prepare elaborate meals, which could further stimulate the economy if consumers feel confident in their financial stability and the performance of their investments. Despite initial optimism following the announcement, market reactions have been mixed. The Shanghai Composite Index experienced a slight uptick, closing 0.5% higher, while Hong Kong's Hang Seng Index fell by 0.4%. This volatility reflects broader concerns about the long-term sustainability of the government's interventionist strategies. China's equity markets have struggled since their peak before the 2008 global financial crisis, with many families reluctant to invest in stocks due to stagnant prices and declining real estate values. Currently, less than 5% of household wealth in China is invested in equities, starkly contrasting with nearly 30% in the United States. This discrepancy highlights a cultural reluctance toward stock market investment and raises questions about the effectiveness of government measures aimed at boosting consumer confidence and spending. In addressing the challenges facing the markets, Wu emphasized the need for pension funds to reassess performance metrics and encouraged companies to engage in share buybacks and increase dividends, thereby enhancing returns for shareholders. He described this shift as a significant institutional breakthrough that could remedy long-standing issues in the market. However, experts like Lei Meng, a China equity strategist at UBS Securities, caution that previous government interventions have often been short-lived, likening them to kindling a fire with damp wood. The sentiment among investors has been affected by past sell-offs and market volatility, which have diminished the willingness of long-term investors to engage with the stock market. The Chinese government is also pursuing foreign investment by unveiling 20 measures aimed at facilitating cross-border investments, as foreign investors currently account for only about 4% of the total market value of equities in China. This is a stark contrast to the United States and Japan, where foreign investment plays a more significant role in market dynamics. Looking ahead, the impact of these initiatives remains uncertain. While they may provide a short-term boost to market confidence, the long-term effectiveness of government mandates in altering investment behavior is still in question. As China grapples with its economic challenges, including sluggish consumer spending and a volatile housing market, the success of these policies will be critical in determining the trajectory of its financial markets and overall economic health in the coming year. In recent days, tensions surrounding Taiwan have sharply escalated, marked by a significant increase in military activity from China. As the geopolitical landscape shifts, the implications of these developments extend beyond the Taiwan Strait, potentially influencing U.S.-China relations and regional stability. On January 23, 2025, Taiwan's Ministry of National Defense reported a substantial military drill conducted by the People's Liberation Army (PLA), which involved the encirclement of Taiwan by 41 aircraft and warships. The exercise saw 35 PLA aircraft and 6 naval vessels detected around the island, with a notable incursion of 12 aircraft crossing the median line of the Taiwan Strait, an informal boundary that has historically been respected by both sides. The Taiwanese defense authorities noted that this drill was part of China's routine joint combat readiness patrols, which have been conducted multiple times a month since February 2024. Chi Chung, a research fellow at the Association of Strategic Foresight, commented on the motivations behind these military maneuvers. He dismissed the idea that they were a direct response to the presence of a Taiwanese delegation at the inauguration of U.S. President Donald Trump on January 20. There was no extraordinary treatment of the Taiwanese delegation, and the military activity does not seem to be linked to their visit, he stated. This perspective aligns with broader observations that the PLA's recent activities lack the accompanying propaganda typically seen during significant political messages, suggesting that the exercises may simply be business as usual for China. Lining Yu, an assistant professor at Tamkon University, echoed this sentiment, emphasizing that the lack of surprise or unusual behavior during the Taiwan delegation's visit indicates that the military drills are routine rather than reactionary. The PLA's last significant exercise of this nature occurred just days prior on January 14, further underscoring the regularity of such operations. The heightened military presence and activity around Taiwan are not merely exercises in show of force, they carry implications for regional security and U.S. foreign policy. The United States has maintained a policy of strategic ambiguity regarding Taiwan, supporting its defense capabilities while avoiding explicit commitments to intervene militarily. However, with increasing military assertiveness from China, the U.S. may be compelled to reassess its stance. Concurrently, U.S. reconnaissance operations near Chinese waters have also intensified, as evidenced by recent reports showing U.S. spy planes operating close to China's coast. This increase in aerial surveillance highlights the broader struggle for dominance in the region and reflects the heightened stakes as both nations navigate their complex relationship. As global attention remains fixed on the Taiwan Strait, the question arises, how will the U.S. respond to these developments? Analysts predict that Washington will continue to strengthen its ties with Taiwan, possibly increasing arms sales and military cooperation in a bid to deter further Chinese aggression. However, such actions could escalate tensions, further igniting a cycle of military posturing that could destabilize the region. In conclusion, the unfolding situation in Taiwan is emblematic of the larger geopolitical contest between the U.S. and China. As military drills continue and both nations assert their influence, the potential for miscalculation remains high. Observers will be closely monitoring the responses from both sides as the situation develops and shapes the future of U.S.-China relations and regional security dynamics in the Asia-Pacific. In a rapidly evolving geopolitical landscape, the relationship between China and its U.S. partners is shifting, particularly in light of recent U.S. policy changes under President Donald Trump. His administration's more unilateralist approach has implications not just for China but also for the broader dynamics in regions traditionally influenced by U.S. power, such as Latin America and Europe. As tensions rise, the focus has shifted to the Panama Canal, a strategically vital waterway that has become a focal point of Trump's rhetoric. During his inaugural address, Trump claimed China is operating the Panama Canal and we didn't give it to China. We gave it to Panama and we're taking it back. This assertion reflects a growing concern among U.S. officials regarding China's increasing investments in the canal and its surrounding infrastructure. However, Panamanian President José Raúl Mulino has vehemently denied any Chinese control over the canal, emphasizing that it remains under the jurisdiction of the Panama Canal Authority, an agency of the Panamanian government. The Panama Canal, completed in 1914 and historically controlled by the United States until 1999, is a crucial artery for global maritime trade. It accommodates around 14,000 vessels annually and handles approximately 5% of worldwide trade volume. China's significant presence in the canal's operations has been highlighted, with recent statistics showing that Chinese companies accounted for about 21.4% of the cargo transiting through the canal from October 2023 to September 2024, making China the second largest user after the U.S. This has raised alarms in Washington, where concerns about a potential supply chain war are palpable. Amid these developments, U.S. Secretary of State Marco Rubio is set to embark on a 5-nation tour of Latin America that includes a stop in Panama. Observers note that this visit is likely to address the increasing Chinese influence in the region, particularly following Rubio's commitment to bolster ties with U.S. allies. Analysts warn, however, that any attempts by the Trump administration to assert control over the Panama Canal could significantly disrupt trade routes and strain U.S.-China relations further. In parallel, the European Union's relationship with China is also under scrutiny, particularly regarding the automotive sector. 3 of China's largest car manufacturers, BYD, Geely and SAIC, have filed lawsuits against the European Commission over tariffs imposed on electric vehicles, EVs, imported from China. The tariffs, which arose from an investigation into alleged subsidies that distort the European market, have sparked a backlash from Chinese firms which argue that the duties are unjustified. Last October, the EU imposed a top tariff of 35.3% on state-owned SAIC's EVs, while BYD and Geely faced duties of 17% and 18.8%, respectively. The European Commission's investigation concluded that these subsidies allowed Chinese EVs to be sold at lower prices in Europe, potentially threatening the local automotive industry. The outcome of these legal challenges could have significant implications for trade relations between China and Europe, as well as for the global EV market. As both the US and EU navigate their complex relationships with China, the implications of these geopolitical maneuvers extend far beyond immediate trade disputes. The increasing tensions highlight a critical juncture in international relations where economic interests intertwine with national security concerns. Moving forward, how these dynamics unfold will be pivotal not only for China and the US but for global trade and diplomatic relations as a whole. The world will be watching closely as these superpowers engage in a delicate dance of diplomacy and competition, particularly in regions where their interests collide.